What's going on, everyone? This is Stephen Place with Precision Volume Alerts, and today we're going to talk about the Fed and the Fed meeting that is this Wednesday afternoon that everyone and their mother is watching because it matters right now. The narrative surrounding the Fed is the main thing, in my opinion, that is driving a lot of the volatility in the markets, and we can see the imprint clear as day on tech stocks, high growth tech stocks, rates, and everything else. So in this video, we're going to talk about some of the markets that you should be watching and some of the tools that you can use to see how well the market is pricing in these rate expectations. Remember, back in November, here's what happened, right? We were seeing more signs of inflation. We were seeing empty shelves. We were seeing the price of energy completely skyrocket, especially in Europe with natural gas and coal and all these things. And what was the word that the regime talked about for a full year? They said transitory. That the inflation's transitory, that it's going to go up, yes, and it's just supply chain stuff, hand wave it around, and then it's going to come crashing down. And what happened in November was that the narrative shifted and that the Fed said, hold up, maybe some of this stuff really isn't transitory. And that, I mean, you can put a pin in it. You can look at tech stocks. That is right when we put a top in the market. Why? Well, the market likes liquidity. The market likes cheap liquidity. And, you know, it was just time. We were due for a decent correction and we got it. So we're going to look at some markets really quick so you can get a better feel and for what we can see with respect to what's being priced in and what we should be looking for right now. Okay, so like I said, right here, okay, this spot, this area of congestion where the market saw that really nasty failed breakdown, we're going to put yep, right there. That's when Jerome Powell came out and put comments out and said, hey, you know what, it's not transitory. So ever since then, this market's kind of traded like garbage. A lot of high growth tech stocks cut in half, down 80%, things like that. So we have seen a drastic shift and repricing with respect to what the Federal Reserve is expected to do this year. Instead of saying one rate hike, we're now saying, okay, is it going to be 2 or 3? Is it going to be 3 or 4? And those kinds of things, you know, that when the narrative is up in the air, you tend to see a little bit more volatility. All right. And, you know, that's what we've been seeing. So the question is, have we seen enough of a tantrum in the markets for the Fed to reprice things a little bit? Because if liquidity does get pulled out of the market and markets go down, let's just say stocks go down, right? The Fed says, oh, we don't care about the stock market. Well, if the stock market goes down, then it becomes a little bit more difficult to finance things as a company. If the stock market goes down, then you don't have enough of a risk appetite to basically hold up risk assets. So the Fed does look at stocks at some point. Eventually they do. The best example is 2016 when the market dropped really hard. Back in January, you had that really hard sell-off and then a bounce and then a double bottom. That was the taper tantrum. So we're seeing a variation of it right now. So we've got the Fed tomorrow at, I think it's 2 p.m. Eastern. What should we be looking at? The first thing you should watch, I've got my notes here just to make sure we've got everything. You can look at the euro dollar. And this basically shows the rates available for dollar-denominated accounts outside of the U.S. And so it can be a little bit more of a pure market to watch. So as you can tell, you know, that don't try and trade this, right? Don't go out and say, oh, this looks really neat. I'm going to go trade euro dollar futures. It is not in my wheelhouse, and it's probably not in your wheelhouse as well, unless you are an institutional fund manager running a lot of money. Don't get involved in actually trading this. We just want to use it for analysis. So this is the first one to watch. And you can see that, you know, during the crash in 2020, this skyrocketed higher. And this is a rates product. Again, I'm not an expert in this. I'm going to just try my best to explain it as best I can. When this is going up, it means rates are going down. It means we're in a deflationary apocalypse. All right. And that's basically what 2020 was. So now it's been selling off, which means rates on dollar-denominated accounts outside of the U.S. have been going up. There's a higher expectation of inflation, and it's kind of leading a little bit. So what we want to look for here, and I'm pretty sure I'm getting this right, if we come into the Fed meeting and basically, if we don't see any volatility in this market, that means that the narrative and the signaling that the Federal Reserve has given us is good enough, right? And that we're not expecting any more surprises, that the future, let's just say the next 6 months are pretty well planned out, even though it's not necessarily what the overall stock market wanted. All right. But if this thing continues to careen lower, then you have the risk of the markets being a little bit more spooked about more rate hikes that weren't necessarily being priced in. Okay. The next one to look at is the Fed Fund Futures market. And this ticker is going to be ZQ. Again, just like I said with Eurodollar futures, don't trade them because, this is not a game to play for retail, basically. So if we look at this again, Fed Fund Futures contract skyrocketed higher during the 2020 crash because rates went to zero. All right, it's kind of, again, interest rates, bonds. You just got to think upside down when you look at them, and so this one right now, this is the front month futures contract, and it hasn't moved, right? But if you go and you look at other futures market durations in this, and let's just say we can go out to something like June, all right? All of a sudden, this looks a little bit different, right? It's falling off a cliff, which means that the rate expectations going into June are completely different than what they were back in November. You can, right here, you can see when it really started to cascade lower, this was a function of, hey, maybe inflation isn't transitory. And then the volatility really picks up right here with Jay Powell's comments in November. Okay. Now, I don't want to look at this all the time. I don't want to monitor different durations and different futures markets all the time. So the CME has a lovely tool called the FedWatch tool, which basically is looking at the Fed Fund futures markets and saying, okay, what kind of rate expectations are we looking for, right now versus 6 months from now, and so on. So this is what it looks like. And I'm pretty sure the way it works, if you look at this, the ZQ futures contract for June is currently trading 99.44. All right. So if we're at 100, I'm pretty sure I'm getting this right. 100 means 0% rates. And then 99.4 means we're at 50 to 75 basis points higher. Okay, so if we look at the FedWatch tool for right now, for the January contract, headed into tomorrow, there's no variation here. Okay, it's saying, 94% chance that we're not going to see a rate hike, and then just some tail risk stuff going on. So from that, it tells me, we aren't expecting a hike. It's about the signaling from the Fed and what they are expecting to do over the next 6 months. Okay, because if we go and we look at the June contract, all of a sudden it gets a little bit weird, right? I'm going to see if I can zoom in for you here. The Fed Fund futures contract for June has a pricing odds of 47% that we'll see 2 rate hikes by June, and then a 40% chance we'll see 3 rate hikes by June. Now, what's cool about this is that they show you historical data. Look at a month ago where it was a 35% chance of 1 rate hike and then a 40% chance of 2 rate hikes. So this has shifted up aggressively. Okay. So what I'm going to be watching with this, and I won't try and do it live while the Fed's doing their stuff in the afternoon, but at the close, I would like to see what the rate odds have shifted to, or if they have started to compress. My thesis here is that if expected rate volatility goes down, equities will go up, because bond market vol does spill over into equity market volatility. And so if we start to see the expected range as we come into June tighten up and we get better odds and better pricing because we have better messaging from the Fed, that will allow a lot of institutional market participants to get in their little spreadsheets and figure out their stupid little DCF models, and then they can get a better idea of, where the markets are headed in the near term. All right. So if the volatility surrounding the narrative goes down, it will cause market volatility to go down. It'll cause equity vol to go down. And that's how you get a really nice rip in the overall markets. Okay. Let me double check my notes to make sure we got everything else. One more thing to watch, and this is the one I'll be watching in the very near term. This is going to be the 10-year futures. And again, if you haven't traded bonds, don't trade bonds, right? Don't look at this and say, oh, this looks fun. Look at the tick size. Look at how much money you can make in this market. Just keep that in mind, just for analysis purposes only, right? The 10-year, it's boring until it isn't, and you can get absolutely run over, right? You can lose thousands of dollars in like a 5-minute candle. So just keep that in mind. But what I'm watching on our roadmap right here, because we are using volume analysis to figure out where market participants are going to position or want to position in the near term. The basic idea here is that when rates sell off, or when this bond market sells off, rates are going up. And when rates are going up, there is a bit of a rotational regime that happens in the markets whereby banks rally a little bit. It's a slightly better environment for banks because they get slightly higher margins, and it can actually hurt tech a little bit as well. So, my theory here is that, we saw a pretty decent sell-off in bonds, which was a strong rally in rates, and at some point the large cap tech sector finally got hit, and so that led to basically coming into a very massive level. And this level is a key LVN. Remember, in bond markets, we deal with apostrophes. I can't even explain it that well, but that's the tick size and so on. So we've got the level that the 10-year was at right before the crash in 2020. So this is a key reference point right here. If it holds and we start to see a rally, you'll see a rally in tech, and that'll just drag the overall market up, okay? That's not guaranteed, but that's the general relationship we're dealing with. If this doesn't hold and this starts to cascade lower, then we have a key volume shelf to look at just underneath price right around here. That's also the support level from back in June. Now, I understand that we're looking at a continuous contract in the futures market, and some Puritans out there saying, oh, it's not the same. I don't care. It's the same for me. And that's how my analysis has worked. Now, if this level doesn't hold in the near term, we've got a liquidity pocket, right, where there wasn't a lot of trade facilitation. Okay. A good example in the near term would be something like it's the NASDAQ, where we have had this liquidity pocket from 342.75 up to 354.5, and we just saw this swift move to the downside. Okay, so once that, if the 10-year breaks into that level, it can spook the markets even further. It's not something I personally want to have happen, but it's a possibility. And if we do get that, then our roadmap shows we've got a level in the 122s that should start coming into play as well. Okay, so that's what I'm watching right now with the 10-year. Okay, the ideal scenario, if you want to be bullish on the markets, is you want to see the euro dollar, you want to see the Fed fund futures like June, July contracts, and you also want to see bond market. You don't want to see a ton of volatility, right? You don't want to see massive ranges. You will see some just because it's a Fed day, but if it starts to cool off and we kind of flatline a little bit, it means that the market's priced in the change in the Fed narrative in the near term. So that could be a good thing to look for. So I think we've covered it. I think we've got all the Fed stuff taken care of. Hopefully this gets you nice and informed as we head into Wednesday afternoon. If you do want to learn more about our roadmap analysis and how we do this, because it does also work in the futures market and the bond market, and anything that has a lot of liquidity and a lot of volume traded, we can get a significant edge in the markets with our volume roadmap. So below this video is going to be a link that will take you to a free training where you can see how we use our roadmap and how we use options to really juice our returns, because we know the best odds of where a stock or market will trade into as well. So that's why we like to use options with it. That's all I got for now. Thanks so much for watching. Have a great day.